Okay, welcome everybody. My name is Sam Seiden from Online Trading Academy. Welcome, thanks for your time. Today we're going to go over short-term trading in the Forex markets, and I'm going to run you through a little strategy we use. I run the Forex trading room at Online Trading Academy, and while we certainly cover short-term trading, swing trading, and position trading, today we're going to go over short-term trading. There's a number of ways you can do this, but what we'll go over today is a pretty simple little mechanical strategy we use. Okay. For those of you that don't know who I am, I'll give you a brief history. I started my career on the floor of the Chicago Mercantile Exchange, actually handling the currencies. Okay. And to make a long story short, down there on the trading floor, one of the things I learned early on is that trading is really no different than any other business. It's the people that know who get paid from the people who don't know. Okay? It's really, trading is really a transfer of accounts, right? From the novice, it's the novice trader simply slowly depositing their accounts into the accounts of the professional traders. Okay. One of the things that's very important to understand is that a lot of people will use indicators and oscillators, use them, and a lot of people run into trouble with that. What we're going to do here today is use some of the conventional indicators and oscillators, a couple of them to be specific, but we'll use them in a very non-conventional way, okay? Not taking every buy and sell signal that they produce, but using them to really help us find that novice trader entering the market, okay? We want to find someone entering the market at the very wrong time, all right? On a trading floor, one of my main responsibility was to take and handle institutional order flow, okay? Hang on one second here. Let me take care of something. Just a second. Okay, so my main responsibility on the floor of the exchange in the beginning was handling institutional order flow. Okay, I would take big orders from mutual big hedge funds, institutions, money managers, things like that. And so you'd have all the orders in front of you. You'd see where all the real demand and supply was in a market, okay? And let's say you're looking at the yen, which we're looking at here, small time frame of the yen. Let's say on a trading floor at 89 even right up here. Okay, I'll use my pointer. Let's say at 89 even here, I had a huge amount of supply. Lots of sell orders were taken there. Okay. How would I know that? Well, I would take the orders and I'd have the orders right in front of me, right? Okay. Like in any clerk down there. Well, what would happen every day is that wherever that big supply was, prices would usually rally up to that level. And as prices got, close to that level and then eventually at that level, one group of traders would come in and buy, and it wasn't the institutional group. It was the retail trader, okay? We had two sets of phones. We had the institutional lines and the retail lines. And the retail group would always come in and buy where all the supply was, just like they would always come in and sell where all the demand was, okay? That group was constantly making two mistakes. They would be buying after a period of buying, selling after a period of selling. Okay? Now, so again, I noticed right away that trading was just simply a transfer of accounts. It was the retail accounts slowly, most of the time, being transferred into the institutional accounts. Okay? So instead of my focus being, what are these in the Forex world, what are these global economies doing? You know, what are the interest rates across different countries, which typically attract higher currency valuations and things like that. My focus right away was on identifying that novice trader. Okay. So what I'm going to do today is really show you what that looks like. Okay. Yeah, I'll get you those settings and all that stuff in just a few minutes. All right. So what we want to do is I want to show you something right here. Let me point something out for you. Okay. I'm just going to draw an area on this chart. Okay. All right. And I'm going to put it right up here like this. Over. All right. Can everybody see that shaded area on the chart I just drew in? Everybody can see that okay? Okay. If you focus on this area, what I did was I shaded in, okay, the top of this big cluster of candles, really focusing on where the majority of trading took place up here. Okay. The pattern we have here is a rally, base, and drop. Okay. For us, that would be a definition of a nice supply level. When I use the word supply, I'm simply interchanging that with the word resistance. When I use the word demand, I'm simply interchanging that with the word support. Okay. Why call it supply and demand? Because that's what it really is. Okay. So we have this supply level up here. Now, how can we be relatively certain that there's a lot of supply for this currency up there? Okay, that there's a lot of resistance up there. How can we be fairly certain that is there? Well, remember, a supply level is a price level where we think there's more sellers than buyers. Okay. Here there are clearly more sellers than buyers, and how can we be so certain of that? Well, prices dropped, as Joe's pointing out. Okay, prices declined from this level; they couldn't stay up here. Okay, so if what I was just saying was not true, if that was not a supply level, prices would be trading sideways here the whole time. But the truth is, they couldn't. Okay, they had to drop and fall away from that level because simply there were more sellers than buyers up here. Okay. On a trading floor, on a trade desk, what would that picture look like? Well, you'd have a giant stack of sell orders at whatever price level that was at. Notice here to the right, eventually prices come back up to that level. When prices come back up to this level, all right, not only they're coming back to this shaded area, okay, but they're piercing the upper Bollinger Band. We can see we have an overbought CCI, all right? And if I brought this out to a bigger time frame, this is only a 5-minute chart, you'd see that at this point we were in a nice little downtrend, okay? Yeah, I see there's a lot of questions on the settings. Just to get that out there, you can really just use the default settings, okay, which are usually the same. Okay, that's a 20 for the Bollinger Bands and 14 for the CCI. All right, so here's what here's kind of the meat of what we're getting at. Okay, our job as we want to be a consistently profitable trader is to identify when the consistent losing trader is entering the market and simply take the other side of their trade. Okay, so let's walk through this here. Somebody who's buying after a big period of buying, and they're buying right into an area where the chart suggests there's a lot of supply. They're also buying when we're piercing the upper Bollinger Band, which is an indication that the market's overbought. And they're also buying when CCI is in overbought territory. Okay, that person is typically making a big mistake. Only a consistent losing trader would buy after a period of buying into a supply level when prices are piercing the upper Bollinger Band and we have an overbought CCI. Okay, everybody understand those 4 mistakes that they're making? Now think about it. Put yourself in the shoes of the buyer up here, okay, right at this point. Yeah, that's another one, EMOT. They're also buying in the context of a bigger picture downtrend, all right? And let me just show you that here. Okay, here's that bigger picture downtrend, the chart over here. Oops. Okay, there's that bigger picture, just a bigger time frame. There's that downtrend. You can see lower highs, lower lows. All right, inside of that, we've got this 5-minute picture. Okay, let's think. Now let's think of. Let's put ourselves in the shoes of the buyer here. Imagine if your buy signal, if your strategy had you buying after a period of buying in the context of a downtrend into an area of supply, right, or resistance. Okay. When prices pierced the upper Bollinger Band, and when we had an overbought CCI, how would you like it if that was your buy signal? How comfortable would you feel buying there? And what do you think the chances are that you would make money with those trades? All right? How would you feel about that? Probably not very good, right? The probability of your trade working out is extremely low, probably about as low as you can get. Okay? So therefore, if you found the lowest probability time to enter the market, haven't you also found the highest probability time to enter the market? Okay? Here's the key, using some conventional technical analysis tools and then wrapping, kind of objective analysis around that, okay? Identifying the novice trader by quantifying supply and demand in any market, any time frame. We're now able to identify when that novice trader is entering the market and simply be there to take the other side, okay? How would you enter this market? Okay, there's a couple ways to do it. All right. Let me draw this in here for you. Okay. Let me, well, that's not really going to show up. I just kind of drew that circle around that area, but, okay. The parameters, again, I know people keep asking. I'll just say it again. You're fine using your default settings. And remember, we're going to run through a bunch of these markets, and we'll kind of do this together. I'll show you how we do this. Okay. As far as the settings go, you'll find that there's two types of traders. There's kind of the number crunchers that are using conventional indicators and oscillators, constantly changing the parameters to see what worked in the past. All right. What happens there is most of that group runs into the issue of form fitting. Okay. What they're really doing is regression analysis, which doesn't mean a whole lot going forward. Then you don't see the number crunchers typically making a lot of money trading. Okay, the people that can really stick to the the simple, wrap some simple logic around the conventional tools. Okay, that's another way to do it, and that's the way that typically works. Okay, so don't start adjusting parameters and stuff to see what worked going backwards. Okay, what really makes the strategy work is obviously the ability to quantify your supply and demand and put your lines in the right areas. Okay, so find someone that's taking the lowest probability trade you could think of and simply be there to take the other side of that trade. Okay, the two ways that you can enter this position, you can use the supply level itself. You can let prices come into the area, and once all your criteria becomes true, you can then sell short as prices decline from the area. And when you do, you would put your stop just above the area. Okay. For exits, you can use multiple exits. Okay. You can use the opposite Bollinger Band as target 1. And then you can also look at the chart and look to the left and find your nearest opposing demand level and use that as another target. Okay. What some people do is, once prices cross back below the midline here, can everybody see my pointer here? once prices cross back below the midline, okay, you can use that as a trail stop as well on part of your position. Okay? All right? And, this is really for trading the Forex markets, short term, all right, which a lot of people like to do. All right, so let's take a look here. Let me, yeah, absolutely, it's the same for all the other indicators, okay? And we were just looking at the dollar yen there, so let's do something a little bit different. All right, and we'll take a look at the euro. Yep, let me capture the chart for you here. Okay, here we go. Sorry about that. Okay, so let me show you this one here. Oops, to get the chart going. There we go. Everybody can see that chart okay? All right, so in this one, a couple things here. Let's do this one. Let's look for a potential trade setup that going forward. Okay. So if we go to the, oops. All right. So let's find a in this market. We just looked at a potential shorting opportunity. Let's find a potential buying opportunity here. Something we would consider on the long side, okay? How do we find demand? How do we find support? You can see my arrow, okay? Can you guys see my pointer moving around? All right. The way that we find support, the definition of support for us is going to be decline, base, and rally. Okay, that'll be the picture of demand for us. So if we start with current price, okay, and we simply go down the price ladder, okay, until we find this level right here. Drop, base, rally, okay? When we find that, the first thing we want to do is go get some lines, and let's wrap some lines around that area here, okay? And we want to extend those lines. I went to a 2-minute chart here just to give you a little variation, okay? 2-minute chart, 5-minute chart. Okay. So now we extend those lines forward and we carry them forward, okay? Why did I do that? Well, because the chart is telling us that there's likely to be more buyers than sellers here. Demand likely exceeds supply here. How do we know that? How can we be certain, so certain, all right? Well, it's because when prices were here, they could only stay here for a short period of time, and then you had this strong rally from this area. We understand that prices could not stay here because behind the scenes, inside these candles, there were simply more buyers than sellers, okay? That's why prices rallied, all right? So what we want to do is carry these lines forward because when someone, if and when prices come back to this level, which, I've never seen prices not come back to a level. They always do eventually. When prices come back to this level, okay, all right, someone will be selling after a drop in price, probably below the lower Bollinger Band. And if the CCI is overbought as well, we can be fairly sure that we're novice sellers coming into the market, and we may have a low-risk buying opportunity on our hands. Okay? Does everybody understand that? And you would do the same thing above current price. Okay? Using something like the Bollinger Bands in and of themselves, simply buying when prices pierce the lower band and selling when prices pierce the upper band, that's not good enough. Okay? Wrapping key support and resistance levels, key demand and supply levels on these charts is really kind of the backbone that makes this strategy work. Okay, having a rule-based way to enter and where to put your protective stops, how to manage the position and take your exits properly. Having a real rule-based system to do that can really make a strategy like this robust, right, if you do it properly. Okay. You could do this on any time frame, all right? When using the indicators and oscillators, I'll typically tend to go to the smaller time frames. If we wanted to find the supply level here, okay, again, you could simply stay on this time frame, or you could go to a little bit bigger time frame. And I'll show you some variations here. All right. So if we want to find a supply level, we simply look for that cluster of trading activity above current price, where prices couldn't stay at, where we had a nice drop in price. Okay, if we come to this time frame, the level that kind of comes out at us here is this area up in here. Okay, we can keep it real tight and use that, or we can go more conservative and use that wick up there as well. It's kind of a big area, but okay. Notice how I'm putting my lines around the majority of candles, right? See all the candle bodies in this area? Okay. We want to make sure that the majority of candle bodies are in between our two lines, because that's where the majority of trading took place, right? Think of those orders, the order flow that I talked about when we started today. Okay? We want to find someone who's buying right in the meat of that supply, right into the meat of that supply. Okay? We want to wait for prices to pierce the upper band. Okay? We want to see that CCI is overbought. In other words, we want to find someone who's making a big mistake. Okay? According to the laws of supply and demand. Okay? All right? That's the key here. We're using these tools, combining them with supply and demand analysis, all right, to help us find someone who's making a mistake according to the laws of supply and demand. Because anybody that buys after a period of buying into a price level where there's more sellers than buyers, above the upper Bollinger Band, and when CCI is overbought, okay, odds are that trader is going to lose money over time. Okay, so we want to be there to take the other side of that trade. It's the low risk, high reward, and high probability time to enter the market. Okay. So Terrell's asking a good question there, right? What's the difference between a demand level kind of that works and one that doesn't? All right. That's kind of your question there, right? Let me if it is, let's go over a couple examples here. Okay. If you focus your eyes right here, there you go. Everybody see these two levels, this area I'm shading in right here? Can you see that on the chart? Everybody can see that okay? All right, good. So now that you can see that, I'm going to remove this. We're going to draw a couple lines around those areas. Here we have a drop, base, and rally. And then here we have a rally, base, and rally. Okay? Now here, I'm just going to put in some trend lines around this level. And let me make that a white line for you so you can see it okay. You'll see one of the things, there's a couple things that make this, that help guide your eye to the proper area versus the wrong area. Okay? So there, I've wrapped some lines around the bottom level. Here now, I'm going to wrap some lines around the top area. Okay. There we go. So you can see that the pattern is key. We do not take the rally, base, rally as one of our key support levels. Okay? That's really just more of a speed bump. The rally, base, rally is always going to be found in the middle of moves. Okay? Which is not really high probability. Okay? The drop, base, rally, okay, that pattern is a much stronger pattern. Okay? The drop-based rally is always going to be further, by definition, the drop-based rally is always going to be further out on the curve. Okay? When you're comparing demand levels, this one on the bottom here is the pattern we take. In the trading room that I run at Online Trading Academy, we tend to ignore the rally-based rally pattern as an entry point. Okay? Do you see the difference there? Again, the drop-based rally forces you lower on the curve. All right? It's a minor thing, Terrell, but it's really very important. Okay? I mean, it may appear minor, but it's really very important if you think about it. You can see when prices come back to both of these levels, when they come back to the upper pattern, which is really low probability, they kind of just go right through it. You get a little bounce there, but the level itself is really ignored. However, the first time they come back to the lower level, the drop basin rally, right in here, that produces, one or two, much bigger turns. In fact, we just had another turn not all that long ago in this level. There's some other things that we look at when quantifying our demand and supply levels. Okay, so we would take this bottom level and we would ignore this upper level. Okay, so I will remove lines from that one now because we wouldn't take that as a demand level. This is our definition of demand down here. Okay, but as you would put your stop just below if you enter at the level. Right in here, you would put your stop just below the level. Okay? Yeah. There's two ways you can enter these positions. There's two ways we enter them in the trading room. Once you get very good at quantifying your supply and demand levels, okay, and when you're comfortable, you can start using limit orders, which means you would buy right at this top line here when prices come back, and you would put your stop just below the bottom line. But if you're not, if you don't have a lot of experience, and maybe you're not that good at drawing your levels in, what you're better off doing is letting prices come into the level and then buy just as they're leaving the level. Okay, we call that a confirmation entry. Okay, and when you buy there, you still put your stop below the level, but the key is that you're letting prices come into the level and then waiting for confirmation of them leaving the level for that one. That's a more conservative type of entry. The reason why it's a little safer, especially for newer people, is because maybe you've picked a level that's not a correct level. Maybe it's not far enough out on the supply-demand curve, and prices come into the level and then just go right through it. Okay. Well, if you use the confirmation entry, you simply wouldn't enter that trade and you wouldn't get hurt. Okay? Does everybody understand that? The reason why you wouldn't just buy right in the middle of the zone is because your best levels, your demand levels, where the number of willing buyers greatly exceeds the number of willing sellers, those you're barely going to, the first or second time you come back to those levels, typically you're barely just going to touch the level and turn higher. Okay? Be careful focusing on the wicks and candle bodies too much, the difference between the two, because that's just going to be a function of the time frame. Okay? Full Global, you're bringing up a good point there. What's your rule about the number of times price revisits the area? There's a little kind of thought there that really can take you looking from this in a very subjective way to a very objective way. Let's talk about that now. Instead of looking, what most people do is they focus on the touch count. They focus on how many times prices have come back into the level. Okay. We actually also do that a little bit as well in the trading room. Okay. But there's a better way to do it. Instead of focusing on the touch count, how many times prices have come back to the level, instead, you probably want to focus on how deep prices are penetrating into the level. If the first time prices come back to the area, like here, if the first time prices come back into this demand level, they just barely touch the level and turn, or there's a very shallow penetration and they turn, what does that tell you about the supply and demand equation inside the demand level? Is there likely to be still a big supply-demand imbalance or a small supply-demand imbalance? Right, there's probably a lot of buyers in there, okay? The chart and shallow retracement is telling you that. Therefore, you can then take the next pullback in price, okay? In the trading room, we run through a simple checklist of 6 odds, what we call odds enhancers, okay? and we give them a score. And what we're doing there, I'll kind of give you the short version, is we come up with a probability score for our trading setups. Okay, we run through the same process every time we find another setup, and we come up with a probability score. One of the things we look at is how did prices leave the level? Okay, right? Was it a slow, gradual rally, suggesting that supply and demand at the level is out of balance, but maybe not in a big way? Or was it a very strong move away from the level? Okay, yeah, how fast did they move away from the level initially? Okay, over here when the level was created. The stronger the initial move away from the area, typically the bigger the imbalance of buyers to sellers at the area. Okay, so a strong move away from an area would typically give us a pretty strong, pretty high probability score. All right. So let me just bring this chart back down to a smaller time frame, and let's draw our lines in again at this area here. Okay. Now, how did prices leave that level? Okay, initially, this price movement right here, was it a slow, gradual drift higher, or was it a strong move away from the level? Yeah, it was pretty strong. Okay. Again, what does that tell you about the supply-demand equation at this level? Small imbalance, or is there likely to be a big imbalance of buyers and sellers? Okay. Yeah, the chart is telling you that, there's probably a lot of demand there. Okay, in the short term. All right, because prices moved away so strong. Another thing, a reason why we like kind of the pivot lows and pivot highs so much. Right. Another one of the odds enhancers we go over in the trading room is look at how much time price spent at the level. Okay, did prices spend a lot of time here or just a short period of time? All right, was it a lot of time there, or maybe just a little bit amount of time? Right, prices were only there for a short period of time. Okay, you as the astute market player, you need to understand why prices could only spend such a short period of time there. It's because behind the scenes, what you don't see on the chart here is that there's a big imbalance of buyers to sellers. Okay, there's a big stack of buy orders there and no sellers. That's why prices could only spend a short period of time there. One of the things I stress early on in the education portion of the trading room is that new traders that are into the program is that they quickly move from a level of just kind of looking at red and green candles on the chart and identifying conventional technical analysis chart patterns. They move from kind of that level to a deeper understanding of the order flow that's responsible for the creation of these candles. Okay? When you can see inside these candles and start to understand the order flow, look at the supply and demand, it becomes kind of a whole new picture for you. All right? As far as news goes, economic events and news, it's good to know when those numbers are coming out because you can then know when to expect big moves in the currencies. But as far as that affecting or impacting your predetermined demand and supply levels, right, support and resistance levels, we don't let the news or numbers affect our levels. Okay? If a big number's coming out, typically we don't abandon our strategy. Okay? What the news and numbers tend to do is simply speed up what was going to happen anyway, right? No matter what the news is, typically after the number comes out and prices start moving really quick, at the end of the day, they're just moving to and from your objective supply and demand levels anyway. Okay? Yeah, Terrell and anyone else, if you're looking for more information on all this, you can always look at there are other recordings on fxstreet.com that I've done that are just focused on supply and demand. There are a number of lessons there, and perhaps we can provide the link for you here. on FX Street that will show you that really just spend the whole time quantifying supply and demand, going through all the little nuances there. All right, so you can see I just got an alert here in the pound yen. So what we'll do is let me just pull that up. Oh, we're actually looking at the pound yen here. It's just because prices pierced the upper band, so we're getting an alert there. Okay. Do you need to use the Bollinger Bands and the CCI to make something like this work? You don't. Okay. You can simply take all that stuff off the chart and simply focus on your levels. That's what I tend to do. But people, especially newer traders, they want confirmation. Okay. All right. They want confirmation, so there's nothing wrong with using something like Bollinger Bands and a CCI, an oscillator like that, in conjunction with your predetermined levels. Okay. As far as the direction of the trend, you probably don't want to do that in a smaller time frame like this. You're going to be better off doing that in a larger time frame. So if we're looking at a 2-minute chart here, maybe go to a 30 or 60-minute chart. You can simply use a 50-period moving average on that time frame. Just quickly glance at the slope of the moving average. You don't need to make it get all complicated, okay? You know, something like you can use a 20-period moving average. I tend to use something a little smoother like a 50 and a bigger time frame. Okay, just a nice general setting that just shows you kind of what the trend is. Okay. Now I use a simple moving average. So again, I know we're running out of time. Just to kind of wrap things up, we do this work to help us identify when the novice trader is entering the market. Okay, when someone is entering the market with the odds stacked against them, we want to recognize that and take the other side of that trade, because that means that the odds are likely stacked in our favor. Okay, we want to do it at these key levels because the risk is low, the reward is high, and by using these tools, we can also do it when the probability of success is very high as well. Okay, so let me give you let me put my email address in the room here. Okay, so there's my email address right there, Seiden@tradingacademy.com, and hopefully that was helpful. Okay, and all right, and we'll see you again soon. Okay, we'll be back real soon to do another one of these sessions. We'll probably just look at levels next time and go that route. Okay, all right, have a great day, everybody. Thanks for your time.